It's nice to see you. My name's Catherine. If you don't remember, I'm your financial advisor. And today I believe you'd like to talk a little bit about mortgages, sort of find out your options, learn a little bit more about how they work. Okay? Okay. So I think that the best place to start would be to just give a definition of a mortgage. Now I know you know what a mortgage is, but it's just very helpful to start there, and then we can build upon that with information that you might not know, or that might not have been presented to you in a way that was easily understandable. And that's what I'm going to try and do today. So a mortgage is a loan given by a lender to a borrower, that's you potentially, and it's specifically for a piece of land or a property. And this is given over a predetermined amount of time. So if you choose a repayment period of 15 years or 30 years, then you have to pay back the loan within that time. And the loan structure will be as such that your loan payments are divided into all of the months that take you up to that period. So for this loan, the property itself or the piece of land that you buy is used as collateral to secure the loan. So if you fail to make your monthly payments for too long, the lender has the right to foreclose on your property, so essentially sell it to recoup the funds that they lent to you. Obviously that is not ideal, and hopefully the information today will help you to avoid any situation where you would be in the position where you wouldn't be able to afford to pay back your monthly payments. So that pretty much summarises what a mortgage is. There are a few components which decide your monthly payments. So the first thing will be the size of the loan. So obviously the more money you borrow, the higher the payments that you'll be making back every month. Another thing that directly contributes to the size of the payments that you'll pay monthly to pay off the loan is the repayment period. So obviously to pay a certain amount back over 15 years, you'll be paying back the money more quickly, so it will be a higher monthly payment. And really the only reason to do this is if you're buying something well within kind of your budget. Whereas if you chose to spread out the mortgage repayments over 30 years, you would pay back less. And you might be thinking, why doesn't everyone just take out a 30-year loan if, it reduces your monthly payments? And that takes us to interest rates. So if you go for a 15-year loan, then the interest rate that you also have to pay on top of your principal, which is the loan amount that you ask for, say you ask for 200,000, the percentage, the interest rate that your bank will charge you will be lower on that loan if you choose a shorter repayment period, and that means you're paying back less over time and you pay off your debt more quickly. So that is the appeal of the 15-year repayment period. And obviously the higher the interest rate, the more you can expect to be repaying each month towards paying back your loan. The size of your down payment also makes a difference. So in addition to, maybe not needing to borrow as much money, which obviously reduces your monthly payments because you'll have less to pay back, if you manage to save up 20% of the value of the property that you're buying and have that as your down payment, then you do not need to factor in another cost, which is private mortgage insurance, which if you have a down payment underneath 20%, you also have to pay for that monthly just to secure your loan. I know there's so many payments, it's really it feels like you're charged a lot for having less money, but I won't get into that. So I know that I have just garbled a lot of information at you there, so to make things a bit I'm going going to take you through an example of if you were to take out 200,000, what that would look like. So we took out 200. Okay, so 200k, and I apologise, I know I am using a red pencil. I'm embracing the child in me. And say your mortgage lender, probably a bank, offered you a 5% interest rate. Now, a 5% of 200k, you might think, oh, that's 10k, that's not too bad to pay on top of the original principal amount in order to borrow that much money. But no, that is a 5% annual interest rate. Which, to shorten things, and I'll explain more as I go through the example, but essentially that means that for a 200,000 you might pay something like 300,000 over a 30-year repayment period. But as my colleague likes to point out, it might sound a bit insane to you right now to think of paying 300,000 overall for a 200,000 loan. It's not as bad as it seems, because, for example, in 1990, 100,000 then is worth 240,000 roughly now in purchasing power. So by the time you get round to paying the final, 50k or something, it'll be like spending a lot less money, if you catch my drift. Unless, wages continue not to increase and inflation continues to increase, in which case we have much larger problems than mortgages. But yes, so if we take into account that the value of money is in general continually rising, it won't be like paying that when you actually get around to paying it. But what happens is this 5% is calculated daily actually, but you pay this 5% annually on your remaining principal. So all of this is principal, and then you pay the 5% interest rate. So at the beginning of your mortgage, you'll be paying mostly interest, and then as you slowly start to chip away at your principal, say it goes down to 180k, the ratio of interest you pay compared to the principal will shift, so that by the end of your loan you're paying 0 interest and just principal, which is, essentially you get charged a lot more in interest because the principal is so large in the beginning. But as the years go by, this annual interest rate, it has a much smaller effect because there is, far less money as we go. So, 5% of 180k be much larger than 5% of 90k, 50k, etc., etc. But yes, that is the annual rate. It's not a flat 5% of 200,000. So in this example that I just used, that is for the most common type of mortgage, and that is a fixed rate mortgage, and that is the mortgage I would typically recommend for everyone because there are so many online mortgage calculators that will enable you to see what your monthly payments are going to look like essentially for the entire repayment term, so you can really plan your finances, which is always helpful for staying out of debt, for being able to plan your future, your family's future. But you have probably also heard of adjustable rate mortgages, and these are named as such because unlike the fixed rate mortgage, it has an interest rate that fluctuates, whereas if you're given terms with a fixed rate mortgage that says the interest payments are 5% annually, then it's going to remain 5%. It's not going to change regardless of what else is happening. So with an adjustable rate mortgage, it will change based on broader economic trends, like, you know, government financial institutions changing the interest rates in banks and stuff like that. So if interest rates increase, your interest rate on your mortgage may also increase. And this might sound fine in theory because, you know, they're only doing to your mortgage what is happening in the economy anyway, but just because something's happening in the economy doesn't mean it's happening for you. So if things are going really well, for most people, it doesn't mean that it is going to be going financially well for everyone. So that can get tricky, and you're putting yourself more at risk with an adjustable rate mortgage. But some people still decide to go for them, and I will tell you the reasons now, because it is the right choice for some people. So the first benefit to having this is if interest rates are reduced, you don't need to refinance your mortgage because you already have the best deal because they've adjusted your interest rates to match, you know, what's going on in the economy. Secondly, I think probably the most common reason that people go for a variable rate mortgage is because they can offer lower interest in the beginning. Like, so quite often they'll have a set period, like 3 or 5 years, where you have a fixed interest rate, and this will typically be lower than the interest rate offered by fixed rate mortgages. So if you're going to struggle to afford mortgage payments right now, then this is an option. But I would say be very, very sure, as sure as you possibly can be, because obviously no one can be absolutely sure, but be as sure as you possibly can that you're going to earn more in the future, because the adjustable rate mortgages often end up being more expensive over the long term. But you know, if you're in a job where you don't earn a lot but you're forecasted to have massive growth in a few years, then, you know, it's a good option if you just want to move into a house, start a family, all of those sorts of things. Another benefit, or another case where this is suitable, is if you're only planning to have your home for a short period of time. So I already mentioned that quite a lot of variable rate mortgages, they have a fixed and often less expensive interest rate mortgage and monthly payments in the beginning. So if you're only planning to own your home for a short period of time, whether it's just like a starter home and you plan to upsize, upgrade in a few years, or whether your plan is to flip the house and make a profit, adjustable rate mortgages are also good for that purpose. So, you know, if you don't know too much about mortgages in general, the variable rate mortgages can just look like really good deals. But as I said, I would always personally go for a fixed rate mortgage. And I think the anecdote that cements this in my mind is actually one that I heard about when I was very young, maybe 12 or 13, whenever we were learning about World War II in school. And I just connected that information to my mortgage studies, I guess, later on, because I didn't really understand it at the time, because I wasn't the mortgage guru that I am now. But essentially what happened was, I think it was before World War II, I think it was when Germany was incredibly poor after World War One. Don't quote me on that, I think that's right, but it could have been after World War II, but I'm pretty sure it was between World War One and World War II. Yeah, actually I would stake my life on that, but again, check it out for yourself. essentially they had massive inflation to the extent that people were taking wheelbarrows of cash to go to the supermarket to buy a loaf of bread. It was just absolutely insane. But what it meant was that people with fixed rate mortgages could just overpay their loan, just get rid of their mortgages instantly. But the people who had variable rate mortgages, their mortgages became essentially unpayable. And obviously it doesn't feel like that sort of thing could ever happen again, but there are many things that have happened again on the global sphere that should never have happened again. So I think it's good to stay on the safe side, because we really never know what the next year or the next decade brings. So that's why I would always personally go for a fixed rate mortgage, unless, as I say, you're planning to sell the house in a really short period of time. Now, away from that little tangent, so when you actually go through your mortgage application process, you can choose to do this when you've already found a house, so you'll know exactly how much you need. Or another thing which some people don't think about is you can apply for a mortgage beforehand, and if you have pre-approval for the amount of money that you need to purchase a house, that pre-approval can be really helpful in giving you a competitive edge. Say if the type of house you want is really kind of popular and you're struggling with lots of buyers and you're trying to put in an offer and you're trying to get the house over other people, then it can give you a competitive edge in the sense that the owner of the property that you want to buy, they already know that you're approved for a mortgage, so they know that, you know, everything's going to go through and it's all going to be smooth, and the transition and the transfer of ownership is going to go smoothly. And people, when they want to sell a house, usually they want to do it as quickly as possible. So that's why sometimes it's worth getting pre-approved. Now, to your mortgage appointment, you will need to bring proof of income. So your bank statements, investment statements, any tax returns, any other proof of income, proof of employment if you're employed, proof of your, ongoing self-employment if you're self-employed. Most mortgage lenders also run a credit check, and I have offered you advice on this front before. If you want to improve your credit score, you can refer to our other appointment and our notes from that. I'll leave those somewhere for you. And all of this is essentially just to check that you are going to pay back the money, because your lender just wants evidence that you can repay the loan. Because you might think, a bank doesn't care, they'll just foreclose or anything, but it actually costs the bank money to do all of those things that would require them to get the money back that they lent to you. So the bank really actually wants you to succeed in that way, only for their own self-interest, of course, but they do want you actually to be able to repay this loan and make your monthly payments, unless you go to a really dodgy place and they give you a really, really high interest rate. But yeah, most places, they genuinely want you to succeed and to make your monthly payments. So based on everything that you show them, they will offer you an amount that they are willing to loan you, and this is capped at around 4.5 times your income, usually annually. And then they will also give you an interest rate, and your interest rate will be lower if you have a good credit score. It'll be lower if you choose a smaller repayment period, and it'll be probably lower if you have a larger down payment. And also, just to remind you, if you have a larger down payment of 20% of the value of the property or more, that means that you don't have to pay mortgage insurance every month on top of your monthly payments. And to get any mortgage mortgage at all, regardless of, you know, private mortgage insurance or not, you'll need to have saved up 5% of the value of the property to put down as a down payment. So that's the bare minimum, but people usually aim for more in cash to put down as a down payment. Along those lines, just because you can afford something, and just because, you know, your lender has agreed to lend you 4.5 times your income and they've gone for the absolute maximum they could give you, that doesn't mean you have to or should necessarily take it. I would say that stretching to afford the very best property is not a good idea in most cases. It's not worth the financial stress. If it's an absolute dream house and you'd be heartbroken for anyone else to have it, then I understand that completely, and I would make the decision also to stretch myself. But if it's a situation where, you know, you think you might move houses again in the future anyway, I would always go with asking for a smaller loan just to make it easier to repay each month in the face of many other costs. For example, when you're looking at your budget, people say that you shouldn't spend more than 30% of your income on rent. That also goes for mortgage payments, but if you think about it, a landlord is typically responsible for taking care of maintenance costs. If the roof leaks, that's their responsibility. If your boiler breaks down, that's their responsibility. Whereas when you own your own home or you own a new property, all of that is your responsibility and you can't plan for things like that. So overall, a house usually costs more per month than rent by quite a long shot, so I would always be conservative. It's also very important, more important than it ever was when renting, to have an emergency savings fund. So if you don't have that already, I would strongly urge you to get started, because, yeah, I mean, especially if you have an adjustable rate mortgage, but we're not going to go there because we're going to go for a fixed one. But, you know, boiler breaking down, roof leaks, there are some things that you can't put off, like, you know, there might be some renovations you want even, but they're not the kinds of things I'm talking about. So yes, at the very, very most, you want 30% of your income to be going towards those mortgage payments, and I would say that's like at the top end, so anything under that is preferable. And you can figure out the monthly repayments. There are so many calculators online that you can use, and they're pretty accurate at seeing how much you'd be paying each month. So that would be really good to look at your budget and see where that would kind of fit in, and you would definitely need to add a savings amount to your budget each month just to take into account those added costs that are going to happen now that you're going to be a homeowner. Okay. Well, all that's left after that, after your mortgage has been approved and you're ready to go, is for you to close on the property, and then you and the former owner of the property just sign a few papers, and then legal ownership is transferred to you. So that's everything. I think if you have any questions, you can just say so now. Okay. Well, if you're good for now, please let me know if you think of anything else in the meantime. I'll always respond to your messages if you have any questions or if you'd like another consultation about anything. Okay. It was really, really good to see you again. I hope that that wasn't confusing, because I know that sometimes I get a bit carried away with my explanations, and, you know, I think back to what I've said and I realise that I am completely incoherent. So, yeah, I hope you managed to get some